Dear students, this tutorial video is an introduction into the concept of weighted average cost of capital (WACC) and its application in the context of discounted cash flow. Aim of this introduction is to show you how to calculate discount rates used for different discounted cash flow methodologies. The weighted average cost of capital (WACC) is the rate that the company is expected to pay on average to all its security holders in order to finance its assets. The WACC is calculated taking into account the relative weight of each component of the capital structure. Moreover, tax effects are considered as well. Typically, the WACC for a company financed by stocks with a total equity value E and cost of equity KE, and interest-bearing liabilities with a market value D and cost of debt KD in an economy with corporate tax rate T is calculated according to the following formula. The weighted average cost of capital is very heterogeneous and shows significant variation among different sectors. For example, the automotive sector has a WACC of 8.2%, while the energy and natural resources sector has a WACC of 7.2%. These numbers imply that the cost of capital vary among different industries. In order to measure the cost of equity, one frequently used method is the capital asset pricing model CAPM. The CAPM is an equilibrium capital market model which allows to determine the theoretically appropriate required rate of return of an asset, for example a stock. According to the model, the equilibrium return on equity is given as the risk-free rate, RF, plus the expected market risk premium times the beta factor. Beta is a measure that tells an investor what is the sensitivity of the expected excess return of the asset in comparison to the expected excess return or risk premium of the market as a whole. Now let us look at the components of the CAPM in detail. First, we consider the risk-free rate or basis rate. The risk-free rate represents the interest an investor would expect from a totally risk-free investment over a specified period of time. According to the KPMG Cost of Capital Study 2014, the average risk-free rate varies between 2.6 and 4.4% in the 2006 to 2014 period. The second component of the CAPM equation is the market risk premium. The market risk premium is the difference between the expected return on the market portfolio and the risk-free rate. The market risk premium is time-varying as well and differs among various economies. The graph on this slide illustrates this fact for Austria, Germany, and Switzerland. The last component of the capital asset pricing model is beta. Beta reflects how risky an asset is compared to overall market risk. It is calculated as the covariance of the asset and the market divided by the variance of the market. In practice, for stocks, the market portfolio is approximated by a large stock market index. The beta of the market portfolio is 1. In the context of company valuation using the DCF approach, there are 3 different sources to determine beta. Beta can be specified by the beta factor of the reporting company, the peer group beta factor, or the sectorial beta factor. However, the KPMG Cost of Capital Study 2014 indicates that a significant part of the beta factors are determined using a peer group of companies. When estimating beta empirically, we use a linear regression approach and regress the excess return of the stock on the market risk premium. The slope of the regression line is beta. The reason for using a peer group approach to identify beta is that especially for small or mid-cap companies, a single company beta has limited explanatory power. In terms of regression terminology, the coefficient of determination, R squared, is rather low. In order to reduce this uncertainty, we estimate betas for other firms in the same industry. To determine the cost of equity for the company to be valued, we use the median beta of this peer group. This methodology is also useful for private companies or subsidiaries of corporate companies. We understand now how to determine the beta factor. An important question in this context is to understand the main drivers of beta. As discussed before, beta measures the return or share price variation of the stock in comparison to the market. Loosely speaking, share price volatility results from profit volatility. Potential drivers of profit volatility are fluctuations of revenues, operating leverage, or financial leverage. Let us now analyze the share price of airline companies. Revenue fluctuations and operating leverage, defined as business risk, are comparable throughout most airline companies. However, financial leverage, defined as financial risk, depends on the proportion of capital that the firm raises from debt minus its liquidity. An immediate implication is that highly levered firms should have higher betas than firms with less debt, since levered firms are perceived to be riskier. The beta containing business and financial risk is called the levered beta or equity beta. It is the beta that can be estimated empirically using market data. A beta independent of the capital structure is called unlevered beta or asset beta and only reflects the business risk. By adding a premium for financial risk, one can obtain the equity beta based on the asset beta. We can always move from unlevered beta to levered beta. On one hand, we start from unlevered beta and use the financial leverage of the firm to estimate the levered beta. On the other hand, we adjust the levered beta for the financial leverage of the firm and arrive at the unlevered beta. Let us now illustrate the concept of levered and unlevered beta by means of an example. Suppose the equity of a firm is 346, its financial debt is 46, and that the firm has liquidity of 37, which implies a net debt of 9. The levered beta estimated by the CAPM is 0.86. Based on these numbers, we obtain an unlevered beta of 0.84. Now assume a slightly different set of numbers. Assume that the firm's equity is 174 and its financial debt is 3. Furthermore, the firm has liquidity of 32. The levered beta implied by the CAPM is 0.62. The unlevered beta based on these numbers is 0.75. So far, we discussed how to compute the cost of equity from a theoretical vantage point by introducing the capital as a pricing model. Next, we studied a practical example of the public offering of Artemis to buy FineTool in 2013. The entire evaluation process is illustrated in the following graph, where our first task is to compute beta in order to determine the cost of equity. As mentioned before, the first step is to compute the unlevered beta based on a peer group of 12 similar companies. The median value of this peer group is 0.8. The second step in the process to determine the cost of equity is to compute the levered beta of FineTool. For that purpose, we can apply the formula illustrated before to move from unlevered beta to levered beta. The net debt to equity ratio of FineTool is 25%, and the unlevered beta derived from the peer group above is 0.8. Based on these numbers, the levered beta is 1. Once we know the levered beta, the final step is to compute the cost of equity by applying the CAPM equation. The basis interest rate or risk-free rate is 2.7%. The market risk premium is 5%, and the levered beta is 1. Plugging these numbers into the formula yields the cost of equity of FineTool of 7.7%. Since FineTool is a small cap company, investors require a higher expected return to compensate for risks associated with small cap stocks. These risks are illiquidity, missing transparency, key man risk, and the higher risk of bankruptcy. In the United States, the return for small cap stocks is 7.1% per annum compared to 4.0% for the overall market. This premium of 3.1% reflects the higher risk associated with small cap stocks. For the Swiss market, Small cap stocks yield an annual return of 12.8% compared to 8.3% for the market. Again, the premium reflects the higher risk associated with small cap stocks for which stockholders require adequate compensation. Now we have all the necessary information to compute the cost of equity for FineTool. Substituting these numbers into the CAPM equation and adding a premium for small caps of 2.3% imply that the cost of equity of FineTool are 10%. Additional information about takeovers and transactions can be found under www.takeover.ch. After having carefully studied session 1.2, please start with the review questions. The next session, 1.3, will emphasize on calculating equity and enterprise values.